You're listening to the North Star Law Firm podcast. Clear, practical analysis of tax and bankruptcy matters that affect business owners and individuals. Each episode breaks down a current legal development and explains what it actually means for the people who have to deal with it. Brought to you by North Star Law Firm in Houston, Texas. Here's today's topic.
So welcome back to today's deep dive. I want you to picture something for a second. Right now, your software engineers are, staring at their monitors.
Yeah, just typing away.
Exactly, typing lines of code that could, quite literally, pay their own salaries next year.
If the company actually claims the money, right?
Right. But that only happens if your accounting team actually knows how to read the federal tax code. Because, when most of us hear the phrase research and development, your brain probably defaults to this, cinematic cliche.
Oh, yeah, totally. The white lab coats.
Yes.
Yeah.
White lab coats, sterile rooms, maybe some bubbling Erlenmeyer flasks.
It's a very, 20th century view of innovation. Like, we expect to see a physical invention being hammered out in a workshop or some kind of pharmaceutical breakthrough under a microscope.
But the modern reality is just hiding in plain sight. If your team is building algorithms or wrestling with complex database architecture or integrating disparate systems, you are doing R&D.
You really are.
And if you don't realize that, you are leaving a staggering amount of capital on the table. The gap between what we think research looks like and what the IRS considers research is just a massive financial blind spot for so many businesses.
And honestly, the stakes around this specific blind spot have, never been higher.
Which is exactly why we're doing this deep dive today.
Right, because we're looking at a stack of source material today centered entirely around a piece of legislation that just completely rewrote the rules for software companies. The One Big Beautiful Bill Act of 2025.
OBBBA, short?
Yeah, OBBBA. So our goal today is to map this out for you. What actually counts as research, how this new law impacts your cash flow, and maybe most importantly, how to claim this money without, triggering an IRS audit.
Yeah, let's avoid the audits. So we need to start with the baseline mechanism because the tax code is notorious for making things sound way better than they actually are.
Oh, absolutely.
We hear tax credit and we just assume it's like another deduction. But according to the primer, the alternative simplified credit, the ASC, is a totally different animal.
Right, because deductions just shrink the pool of money you get taxed on. But the ASC is a dollar-for-dollar reduction against the actual tax you owe.
Wow, dollar for dollar.
Yeah. Generally, it equals 14% of your current year qualified research expenses, what tax professionals call QREs, but, and this is key, only the portion that exceeds 50% of your average spending over the prior 3 years.
Okay, wait, so the mechanism here is really designed to incentivize growth, right?
Exactly.
If I spend $1 million on engineering every single year, the government isn't just going to hand me a blank check for maintaining the status quo.
No, they won't. You have to be pushing the envelope. You have to be spending more on development this year than your historical average just to get that 14% reward on the excess.
But what if you're a new company? You don't have 3 years of history.
Then you aren't left out, thankfully. You generally get a flat 6% of your current year expenses.
Okay, that makes sense.
But, and there's always but, the entire system hinges on one incredibly strict definition, which is what actually qualifies as a research expense.
Ah, right. This brings us to the 4-part test. The gauntlet, basically.
It really is a gauntlet. Every single project has to pass all 4 parts.
Let's test the boundaries of this then. So the first part is the permitted purpose. You have to be creating something new or improving the function, performance, reliability, or quality of a business component.
Right.
That seems like a really low bar. If I release a software update that makes an app load 2 seconds faster, I've improved performance.
You have. But that alone doesn't get you the credit because of part 2, which says it must be technological in nature.
Okay, so what does that mean in practice?
The improvement has to fundamentally rely on principles of computer science, engineering, or hard sciences. So you can't just change the font color of your app to make it look nicer and claim it's research.
Right, so the aesthetics don't count, the underlying computer science does.
Exactly.
Which brings us to the third part, the elimination of uncertainty. And I have to push back on this one a little bit.
Oh.
Yeah, because the rule says that at the outset of the project, you couldn't know exactly how to achieve the result. You faced uncertainty about the methodology or the design. But if the IRS is explicitly rewarding uncertainty and trial and error, aren't they basically just subsidizing incompetence?
I love that you brought that up because that is the #1 trap companies fall into when trying to evaluate their own work.
Really? Because think about it. If I hire a terrible junior developer who has to try 10 different times to build a standard login portal,
Ah,
I get a tax credit for all that wasted time.
well,
But if I hire a genius senior engineer who builds it perfectly on the first try, I get nothing because there was no uncertainty.
see, the IRS anticipates that exact scenario. They distinguish between routine capability uncertainty and genuine technological uncertainty.
Okay, break that down for me.
The uncertainty cannot simply be, well, my developer doesn't know how to do this. It has to be, nobody in our company, utilizing the current state of computer science, knows the optimal architecture to achieve this specific result within our system constraints.
Oh, I see. So it's not about an individual skill level at all.
Nope. It's
Yeah.
about pushing the boundaries of the technology itself.
Okay, so if we are trying to figure out how to, scale a proprietary database to handle 1 million concurrent users without any latency, and we literally have to test 5 different architectures to see what doesn't break under pressure.
Yes, that is exactly the kind of uncertainty they are looking for.
Got it.
And how you resolve that uncertainty leads right into the final requirement, the process of experimentation.
Which means what, exactly?
It means substantially all of the research activities, typically 80% or more, must be part of a structured process. So evaluating alternatives, prototyping, systematic hypothesis testing.
Okay, but the source material makes a very sharp distinction about who you are actually experimenting for.
Yes, it does.
Because a process of experimentation for a commercial product is judged very differently than a tool you build for your own company, right? The IRS separates software into 3 distinct buckets.
Commercial, internal use, and dual function.
Let's start with commercial.
Commercial software is super straightforward.
Uh,
Customer-facing platforms, SaaS products, mobile apps you sell. If you are building those, you just apply that 4-part test we just went over.
Seems easy enough.
The friction happens when we look at the second bucket, which is internal use software, or IUS.
This would be the back office stuff, right? Like an internal HR tool to track employee vacation days or a proprietary inventory system that never actually touches a customer.
Exactly.
But why does the IRS even care if I use it or my customer uses it?
Because they really don't want to fund routine administrative overhead. To get a credit for internal use software, just clearing the 4-part test isn't enough.
There's another hurdle.
Oh yeah, you have to pass an additional high threshold of innovation test.
That sounds intense.
It is. You have to prove the software is highly innovative, that it was developed under significant economic risk, and it is not something you could just go buy off the shelf commercially without massive modifications.
Okay, so building a custom vacation tracker is essentially invisible to the IRS.
Or pretty much.
But building a massively complex AI-driven logistics engine that routes your private delivery fleet in real time, I mean, that involves significant economic risk and innovation.
Right, that passes the threshold easily.
But what happens when the lines blur? Because I imagine that happens a lot. This is the third bucket, the dual function software.
Right, imagine a portal where your employees manage logistics, but your external vendors also log in to check supply levels.
That's tricky.
It is.
Mm-hmm.
The IRS basically presumes that any dual function software is internal use,
Yeah.
which forces you into that nearly impossible high innovation threshold right off the bat.
So how do you escape that presumption?
You have to carve it up. You isolate the specific modules or lines of code the vendors use, and you test just those pieces under the easier commercial standard.
I can hear every software engineer listening to this just groaning right now.
Oh, brutal.
Because modern code bases are so intertwined. I mean, separating the exact server load of an internal user versus an external vendor has to be a nightmare. What if you simply cannot untangle the code?
Well, the IRS actually offers an administrative compromise here. It's a really fascinating safe harbor rule.
Oh.
Yeah, if you can prove that at least 10% of the software's anticipated use is by third parties, the IRS lets you claim 25% of the total qualified expenses for that entire project under the easier standard.
Wait, really? That is a massive strategic nuance.
Isn't it?
Just by ensuring that 10% of the usage touches the outside world, you rescue a whole quarter of the development costs from that impossible internal use threshold.
They are essentially saying, look, we don't want to audit every single line of code either, so here is a flat compromise.
It's a pragmatic solution to a really complex engineering reality.
Exactly.
So we have the activities defined, we know the rules of the gauntlet. But if a company clears these hurdles, we have to look at the actual money.
Show me the money.
Right. The source material outlines 4 specific buckets of qualified research expenses that the government will actually subsidize.
Yep. The largest bucket, almost universally for software companies, is wages. So W-2 compensation.
Just for the coders.
No, and that's a critical detail here. It's not restricted strictly to the person writing the code. You can include the wages of the engineering manager directly supervising the project, or even the QA tester who's actively trying to break the code.
Oh, wow. So the entire ecosystem making the code possible is factored in?
Exactly.
Okay, what are the other buckets?
The second is supplies. Tangible property consumed in research.
I imagine for software, this is almost irrelevant.
Pretty much.
Yeah.
You aren't burning through titanium or vats of chemicals to build an iOS app.
You're right.
But the third bucket is huge. Contract research.
Okay, this is where I imagine a lot of companies trip up. Because it's incredibly common to augment a team with an outsourced development shop.
Oh, all the time.
Does the IRS just let me write off my entire invoice to an external agency?
No, not the entire invoice. They allow you to claim 65% of the amounts paid to non-employees.
Why 65%?
The 35% haircut is basically the IRS assuming the contractor's profit margin and overhead. The government only wants to subsidize the actual research, not the contractor's office rent.
That makes sense. But there is a massive geographic wall here, right?
A huge wall.
Like, what if that contractor is based in Eastern Europe or South America?
The rules are merciless on this point. Only U.S.-performed research qualifies. Period.
Wow.
If your development team is sitting outside the United States, every single dollar paid to them is entirely disqualified from this credit.
So the incentive is strictly domestic.
Very strict.
Okay, and what about the infrastructure, like the servers we use to build all this?
That is the fourth bucket, cloud or rented computing. So your payments to AWS, Azure, Google Cloud.
Oh, nice.
But, this is a big but,
What?
the boundary here is vital. The credit only applies to environments used for development and testing.
Wait, so not the live app?
Never. It never applies to your live production environment where your actual customers are operating.
Okay, the mechanism does make sense, though. If I spin up a sandbox server on AWS to test some wild new architecture, that is clearly experimentation.
Right.
But if I am paying AWS just to keep my e-commerce site online so people can buy stuff, that is just routine business operations.
Exactly. You have to actively segregate those environments in your cloud billing.
Because if you don't...
You need that billing segregation to survive an audit. If it's all lumped together, they'll just toss it.
Ouch. Okay, well, now we have to address the legislative earthquake that prompted this entire deep dive in the first place.
The big one.
Because knowing what expenses count is great, but from 2022 to 2024, the reality of claiming these expenses was financially destructive for a lot of companies.
It was a nightmare.
We really need to talk about the dark era of Section 174.
It was such a brutal period for tech companies.
Hmm.
So under the old Tax Cuts and Jobs Act, companies were stripped of the ability to deduct their research expenses immediately.
Which is how it used to work, right?
Right. Instead, they were forced into mandatory capitalization, which meant spreading their domestic research costs over 5 long years.
Let's put a structural analogy to this just so the sheer pain of that rule makes sense to everyone listening.
Please do.
Imagine you buy a massive $1,000 steak dinner for your engineering team to celebrate a big launch. You pay the restaurant $1,000 in cash today.
Sounds like a fun night.
Right, but then the IRS looked at that meal and says, we are only going to let you claim you ate $200 worth of that steak this year. You have to claim the rest of the steak over the next 4 tax returns.
Yeah, that's exactly it.
So you are out the cash today, but your tax relief is just drip-fed to you over half a decade.
That is exactly how it operated in practice. Companies were spending millions on salaries in a single year, but they were only allowed to deduct a fraction of it, which artificially inflated their taxable income.
That's crazy.
They were getting hit with massive phantom tax bills on money they had already spent.
Why would Congress ever design a mechanism that essentially punishes companies for investing in research?
Well, it was originally a revenue-raising mechanism. It was buried in a much larger tax package with the general assumption that future legislation would eventually fix it before it caused too much damage.
But the fix took years.
It did. It finally arrived in the form of the One Big Beautiful Bill Act of 2025.
Ah, the OBBBA.
Yes, the OBBBA enacted a new section, Section 174A, and it fundamentally, permanently restores immediate expensing for domestic research expenditures starting after December 31st, 2024.
Oh, thank goodness.
So the era of forced 5-year capitalization for domestic research is officially over. You spend the money this year, you deduct the money this year.
But the source material highlights a ticking clock here because we aren't just talking about tax returns moving forward.
No, we are not.
There is an urgent retrospective mechanism here. And look, Today is May 7, 2026. What happens on July 6, 2026?
That is the absolute deadline for the transition rules. Small businesses, and they define that here as those with average gross receipts of $31 million or less, have a one-time golden opportunity.
To do what?
You can retroactively amend your 2022, 2023, and 2024 tax returns to fully expense your domestic R&E in those past years.
Meaning you can basically undo the damage of the amortization era.
Exactly.
So if you overpaid taxes in 2023 because you were only allowed to deduct a fifth of your engineering salaries, you can amend that return today and the government has to cut you a cash refund.
Yes. You reclaim the cash that was trapped by the old rules. But the window to make this election closes exactly 1 year after the OBBBA was enacted, July 6, 2026.
Wow.
This is a hard deadline.
That is under 2 months from now. And just to be completely clear, this fix only applies to domestic research, right?
Correct. The government is really doubling down on keeping innovation inside the U.S. foreign research expenses. They remain trapped under an even harsher 15-year amortization rule.
Oh, man. Well, a listener might be hearing all of this and thinking, okay, deductions and income tax credits are fantastic if my software company is actually turning a profit and owes income tax.
Right, which isn't always the case.
Exactly. But I run a pre-revenue startup. I am burning venture capital just to keep the lights on. An income tax credit does absolutely nothing for me.
Well, the tax code has a dedicated lifeline for exactly that scenario.
Okay.
It's called the Startup Payroll Tax Offset.
Yeah.
If you are a qualified small business, meaning you have under $5 million in current year gross receipts and your company is less than 5 years old, you can take up to $500,000 of your R&D credit and road it away from your income tax.
Where does it go?
You apply it directly against your employer payroll taxes instead.
Wait, so instead of a credit sitting uselessly on a tax return waiting for the company to turn a profit, the IRS essentially gives you a cash discount on your current payroll overhead.
It is an immediate liquidity injection.
That's huge.
It really is. You claim it quarterly alongside your employment taxes, and it is actually refundable in cash via offset. So for a startup that's bleeding cash just to pay highly skilled engineers, erasing up to $500,000 in payroll tax liability is a massive extension to their runway.
It's basically the federal government acting as a bridge investor.
Pretty much.
But, the federal government isn't the only player shifting their strategy right now. State tax boards aren't just sitting still while federal taxable income plummets.
No, they are aggressively re-engineering their own incentives.
And the source material focuses on Texas as the prime example of this kind of state-level behavioral economics.
Right, because Texas doesn't have a state income tax, so they have to pull entirely different levers.
They pull the franchise tax lever. And just for anyone unfamiliar, a franchise tax is essentially a cover charge for the privilege of doing business in a state.
Good way to put it.
It's often based on your margin or your capital, regardless of whether your net income is positive or negative.
Right. So effective January 1st, 2026, Texas completely overhauled their incentive structure with Subchapter T.
What did they do?
They completely repealed their old sales tax exemption for R&D equipment, and they replaced it with a highly potent franchise tax credit.
Why shift from a sales tax exemption to a franchise tax credit?
Because software companies just don't buy a lot of heavy taxable equipment.
Right.
A sales tax exemption is great for like a manufacturing plant buying machinery, but it's nearly useless for a tech company whose primary expense is human capital.
Makes a total sense.
So the new franchise tax credit offers an 8.722% credit on excess Texas-based QREs. And if a company collaborates with a Texas university for research, that rate spikes to over 10.9%.
That's a big jump. They are directly incentivizing a talent pipeline between local universities and the private sector.
Exactly.
And the primer notes that even if a Texas startup owes zero franchise tax, Subchapter T adds a refundable component for them as well. So the strategy is moving at lightning speed on both the federal and state levels.
Which brings us to the ultimate reality check.
Yeah.
Getting a government entity to offer you these credits is merely step one. Keeping the money when an auditor knocks on your door 3 years from now is step two.
Right. How do we actually prove that we faced technological uncertainty and engaged in a rigorous process of experimentation? Because I imagine presenting an auditor with a spreadsheet of salaries and just saying, trust us, is a fast track to a disallowed claim.
Oh, the era of napkin math and reverse engineering tax returns is dead. Dead and gone.
I figured.
The IRS demands contemporaneous documentation. They want to see the digital paper trail proving that the research happened while it was happening.
So you are saying the graveyard of bad ideas, the failed code commits, the dead-end architectures, all of that failure is literally a highly valuable tax asset.
It is the single most valuable asset you have in an audit.
Wow.
The IRS wants to look at your JIRA tickets, your GitHub issue trays, your pull requests, and your sprint planning records.
They want the receipts.
They want decision logs that explicitly state, we attempted architecture A to solve this database latency, the server crashed, so we are pivoting to architecture B. That is the literal, undeniable proof of experimentation.
Literally the receipts of your failure.
Exactly. And their compliance demands are only escalating.
How so?
Starting with the 2026 tax year, the IRS is enforcing mandatory Section G reporting on Form 6765.
What does that mean for the accounting team?
It means you can no longer just submit a giant lump sum of R&D expenses. You have to break the cost down, justify the uncertainty, and detail the experimentation business component by business component.
Oh man, project-level reporting sounds like an administrative nightmare for a company running dozens of concurrent software updates. Are there any exemptions to this?
There are a few. If you are a startup utilizing that payroll tax offset we discussed, you are exempt from Section G.
Oh, okay, that's a relief for the little guys.
Yeah. Or if you have under $1.5 million in qualified research expenses and under $50 million in gross receipts, you also get a pass.
Good to know.
But for mid-market and enterprise tech companies, the documentation bar is higher than it has ever been.
The strategic paradox here is just fascinating to me.
Absolutely.
The very things software engineers naturally hate doing, meticulously logging their failures, documenting dead ends, and tracking time spent on abandoned prototypes, are the exact behaviors that generate massive financial returns for the company.
It really requires a fundamental shift in corporate culture. The engineering team and the tax accounting team literally have to be speaking the same language.
So what is the ultimate takeaway for you, the listener, as you look at your own organization today? The R&D credit is not some obscure corner of the tax code reserved for pharmaceutical giants.
Not at all.
It is a vital strategic instrument for anyone building technology. Between the OBBBA restoring immediate expensing, the $500,000 payroll offset for startups, and that looming July 6, 2026 deadline to reclaim trapped cash from past returns, mastering this can fundamentally alter the trajectory of a business.
It really leaves us with a broader, paradigm-shifting question to consider, though.
Let's hear it.
If the federal government is heavily subsidizing the trial and error process of software development and directly offsetting the payroll taxes of pre-revenue startups just to keep their engineers employed, at what point does federal tax policy blur the lines and essentially become state-sponsored venture capital?
Wow, it's an incredible lens to view this through. The government is basically absorbing the financial risk of your innovation.
Exactly.
So the next time you think of R&D, banish the image of the bubbling beakers, look at your GitHub repository, look at your failed server logs, and look at the calendar, because you have until July to claim what is yours.
Thanks for listening to the North Star Law Firm podcast. This podcast is produced for general educational and informational purposes only and should not be construed as tax, legal, financial, or accounting advice for any specific situation. Listening to this podcast does not create an attorney-client or CPA-client relationship with North Star Law Firm. Tax and legal outcomes depend on the specific facts of each matter and on applicable state and federal law, which varies by jurisdiction. If you have a matter that requires professional advice, consult a qualified attorney or CPA licensed in your jurisdiction. For further inquiries or to start a conversation, visit us at htx-legal.net. Copyright 2026 North Star Law Firm. All rights reserved.